Welcome, everyone. Today, we are very excited to welcome Beth Quinn from First Nonprofit, who's going to be talking a little bit about unemployment and the state of unemployment insurance costs, as well as how to mitigate those increases and some cost savings options that are open to you. Beth has been with First Nonprofit for 8 years and has been working with the Alliance in educating and assisting nonprofits in state unemployment. And she enjoys all sorts of things like traveling, cooking, and spending time with her friends and family. So we hope that we are part of your friends and family. Beth, welcome, and feel free to take it away.
Thank you. You definitely are. I was just asking if you guys were accepting visitors yet, and so I miss y'all. Yes, you are our friends, and I look forward to seeing you guys soon. Thank you, everyone who helped put this together, Karina, Angela, and Jennifer. We really appreciate the opportunity, and I say we because I know I speak for First Nonprofit as a whole, to be able to engage with the members and hopefully provide some information or insight that may be helpful, food for thought, or maybe something that you never knew. So hopefully there'll be some pearls of wisdom. I know state unemployment's not the funnest topic, but it definitely hit the radar this year with the pandemic and what followed suit after that. So hello, Alliance members. Thanks for your time today, and I appreciate you joining us and being part of our long-term relationship that we've had with the Alliance. I think it's towards 15 years, so we appreciate our partnership. And again, in the last year and a half, that partnership has really shown its grit because we were able to rely, First Nonprofit was, on helping us kind of figure out the lay of the land just like everybody else. So I do want to say a special thank you to the Alliance for being so available and open and supportive in the last year and a half. So we are going to talk about state unemployment, and if you guys have any questions, I believe Karina mentioned it, please put them in the chat box. You're welcome to ask anything, and I'm happy to address at any time. I want this to be as interactive as possible. So, let me know what I can do. So we're going to cover the short-term impact of basically the pandemic and the amount of claims that states saw nationwide and the changes that happened and kind of how that's leading to some long-term changes, not only in response that happened in 2020 in March, but some of the other legislation on a federal level that's passed since then, and some things that are potentially coming on the horizon that will be more of a long-term impact in terms of how state unemployment looks. And then we'll talk about the cost savings option or risk transfer if you're self-insured for nonprofits and government entities and tribal organizations. All right, so a little bit about First Nonprofit. I know if you guys have been a member of the Alliance, you are probably well aware of this, and I talk about it all the time because if I'm not in front of you on the screen, I am usually at a conference. But First Nonprofit was founded from the United Way, from a grant, and so essentially kind of started off as a nonprofit as well. We're based out of Chicago, and we've been around since 1978. To date, we insure over 2,100 employees nationwide and have over 500,000 employees that we cover. 2,100 nonprofits. We're part of the Amenta Group, which is a private-owned subsidiary of we're part of the Amenta Group and partially owned by AmTrust Financial, and so we are rated 14 A- on the AM Best. So basically a financially sound company is what that information is for. along with the Alliance, we have partners nationwide. And so, and a lot of them have been long-term, like PANO and Oklahoma Center of Nonprofits, I know is someone that the Alliance talks to on a regular basis. So, and of course, the National Nonprofit Association. So over 30 nationwide, and we continue to grow. All right, so on state unemployment history, I know you guys are familiar with this because I hit on it every year, and the reason why I'm bringing it up more so this year is because these guidelines changed dramatically in 2020. So the state unemployment program was in response to the Great Depression, and it was basically for people that lost work due to no fault of their own. So it could be a reduction in hours, a complete loss of a job, but it was there as a safety net to help people, you know, have like a gap, cover that gap for a period of time. The number of weeks that a person can claim varies based on state. The average is most states are 26, which is the case in Arizona, but some states are lower. And that's something that the states can change at any time. So in terms of unemployment, what was consistent up till March 2020 in the CARES Act was that you had to be able to work, you had to be available, you had to be actively seeking work to get your benefit. There's a waiting period in most states, 1 to 2 weeks, and you had to meet the state's monetary requirement, meaning you had to have wages reported through an employer. And again, you know, the unemployment had to be due to no fault of your own. So if I could ask a poll question for the participants out there, if you don't mind answering, how many people are paying state unemployment with like a tax rate, meaning you get a tax notice every year, or self-insured? So I'm going to give.
We'll just wait a few minutes for people to complete.
I see the responses. This is awesome.
All right, I'm going to end this.
Okay.
So it looks like your results are a little mixed, a little bit of everything.
Yep, which I expected. So some self-insured, tax rated. Okay, cool. This helps. Thank you so much. Okay, so for those that, I don't know what other stands for, maybe it's a religious organization or something like that, but whoever may have answered other, if you have any questions specific to your situation, please let me know. So state unemployment, as y'all know, is funded through employers. It's an employer-paid tax. It's mandatory that employers provide it. There are exceptions in terms of faith-based organizations or religious organizations. But most people, as we saw from the poll, over 50% are part of the state trust fund, meaning you get that tax rate. You just pay that based on the range of the rate, which is 0.8 to 20.6% this year is the max in Arizona. So you fall somewhere in there. I would say the average tax rate seems to be about 3 or 4% for some organizations that I spoke to, mostly. If you're larger, it could be higher because it is reflective of claims activity, and I'll get into that in a second. So the primary way to take care of your state unemployment requirement is through the state tax pool. And second is self-insured, which some folks are doing. I think it was 33%. So the option to self-insure is only available to 501c3s, government entities, and tribal organizations, as I mentioned. It's our Internal Revenue Code 3309 A and C, and it's been around since the 70s. And basically, it provides you an opportunity to save some money. For those that are self-insured, it would be more of a transfer of risk and exposure because of some of the challenges to have that, full liability of the claims, which can be upwards of about $11,000 max. Okay, so this is important, particularly this year, or 2020 to 2021, and how states are funded. And I know 501c3s don't pay FUTA, but that's what funds the state tax pool, or state tax trust, rather. So when those state trust funds are in trouble and go negative, that's where FUTA comes in, because that's the FUTA program funds the Title 12 loan program, which basically loans out money to states to cover their claims. And we definitely saw that happen this year. So any questions pop up by chance?
Oops,
No,
sorry,
no
I
luck?
had a hard time finding my unmute button. Nope, we don't have any questions yet.
Okay, so for the people that are on the phone, I would imagine if you've been with the Alliance for the last year or even beyond, you guys are very well aware of the CARES Act, the language in it, the clarification that needed to happen, and so just for edification purposes, the sections listed are, where you can find this information in the CARES Act. And basically, after some clarification, it provides 50% relief for self-insured nonprofits. And that is to end this year, or I'm sorry, it ended in 2020. And so going forward, the 50% credit is going to be ending, and all charges are going to be 100% on employers to cover. So the FPUC, as we know, is the $600 additional. That's federally funded, as was the $300 a week, which ended September 6th, I believe. In some states, like I'm in Texas, and there were several this direction that ended the $300 payment early. When those states did that, what it did was end the federal subsidy. So here in Texas, the governor made it effective June. And so what happened was anybody that was getting that 50% credit, it ended for them in June rather than December. So I just thought I'd get into this year about kind of how Arizona DES calculates your tax rate, since maybe, like I said, this topic's been more on the radar, or maybe you've read about it because your rate may have increased in the last year, even maybe with, not too much activity, or you were, I've heard there's volatility. Even if it's 0.5%, it goes up every year, and I think that's the case for most folks. So Texas uses a reserve ratio to track charges for employers. So it's based on a historical basis. And I have how they calculate it is they take the total contributions, meaning the charges that are paid out, and minus the total benefits, benefits paid by the payroll. So this is not based on our calendar year. This is based on their calendar year, which is June through July. And then they also look at a 3-year average of your reported UI wages and in determining your rate. The third factor that they use that I didn't put on here is the health and the solvency of the state fund. That's the one thing that you can't really control or predict. And obviously that is what kind of is the biggest driver of what determines your rate. What Arizona DES also does typically, and why you saw a jump from of 8% from last year, and the max rate from 12.85 to 20.6 is they just changed. They use a schedule, and so the state just kind of revamps their schedule. So because the wage base is at the federal minimum of 7,000, that's really the place that they can adjust things to try to generate more, employer payments. So if you're negative rated, meaning that you're negative with the state, people tend to see the higher rates from, again, that 10.87 would be your minimum to the 20.6. As I mentioned, Arizona has a standard benefit period of 26 weeks, and with a possible addition of 13 weeks extended benefits based on the state unemployment rate. And I will hit on that in a moment. All right, I just thought I'd check back and see if there's any questions so far.
Not yet.
All right, either you guys are asleep or this is making sense. So I won't spend too much time on this. I'll just let you, I know it's recorded, but we all know that things were great in 2019, starting in 2020, and for every state, I think across the board was eventually impacted by COVID. So in December 2019, the national unemployment rate was 3.5. In Arizona, it was 4.8. And then come 2020, and we're looking at a national unemployment rate of 14.7. And I have Arizona's down on a future slide. But so we're still seeing high unemployment, as you all know, or reemployment for that matter is pretty low. So specific to Arizona, claims filed between March 15th, which is kind of the magic date, if you will, that marks the official start of the pandemic, or when it was announced, through October 24th of 2020, you're looking at 956,000 claims. That's almost twice as much as during the recession. So in less than a year, you saw more claims filed than during the recession in a 2-year period. Fun fact I learned this year, or last year rather, was that states are staffed at for 4% unemployment. So, I think these claims are representative of a really high unemployment rate. In 2020, it hit 12.6. So, thus many states were behind, and notices were going through the mail if typically where it would typically go electronically. So the states were all really impacted. So this is also a graph, and this is from the U.S. Department of Labor. So this is where we get our information, and I think it kind of speaks for itself from the, employment to unemployment rate, and how it's kind of still adjusting through the course of the last year. So if I may, another poll question, and that is, has your organization seen increased costs? And I know that I'm not being specific on the date. I presume that, let's go back to 2020, 2019, however you guys want to look at it.
Okay, results are coming in. Give it one more minute here. There we go.
Okay.
So mostly yes.
Mostly yes. I'm sorry to hear, but I'm not surprised to hear. Arizona Department of Employment Security, DES, reported that 10.8 billion in unemployment insurance benefits were paid out from March through September 5th. So that's what those 950 something claims represent. To put that in perspective, that is 3.2% of Arizona's personal income last year. So the $600 federally funded payment through the CARES Act, which expired in July, and then was replaced by the $300 weekly supplement, you know, that didn't seem to, I think a lot of people presumed when that ended that the reemployment would reflect that, and that's just not the case. So we're seeing an increase of 838,000 claims in the last month as reported from the U.S. Department of Labor. So we're still seeing a lot of activity. And as people answered that they have seen increased costs, and that would make sense if you see, this is broken down cost per employee. So basically, what is the tax cost for you per employee in 2020 versus 2021? And it has gone up about $60. So I mentioned the state trust fund and how that impacts employers that are tax rated. You can see that the fund was pretty healthy in 2019, and then in 2020, it's you know, essentially depleted, if you would. The good news is Arizona's managed not to have to borrow money from the feds in the Title 12 program, unlike Texas or California and Colorado. Pretty much, I think it was close to 20 states had to borrow. So Arizona's managed not to have to do that, which is great. But the state has seen an 87% decrease in the UA fund balance. So could there be a rate increase? I'm sorry, that should say 2022. Should that be a rate increase in 2022? The prediction is yes. And I'm going to touch on why you're going to see increased costs, whether it's in the rate or the or just your overall cost per employee. I'm sorry, my computer's stuck. Okay. This is just for your edification on what it looked like in terms of, again, you know, before you would not see pandemic benefits listed. In historical times prior to the pandemic, you had standard unemployment of 26 weeks, and then, you know, that was it, unless the state had 4 to 6% statewide unemployment. That's when the extended benefits come in. So here's kind of a visual of what a claimant could collect, the liability to the employers. So essentially, all liability is now on employers going forward. And that's whether you're tax rated or self-insured. So people are able to collect between the standard benefit and the PUC of 13 weeks, plus the additional extended benefits, which just expired in Arizona. You're looking at 59 weeks, if my math's correct. So that's a lot. And so what that means for employers and something to watch out for is you might see an increase in your charges if you're reimbursing this quarter, fourth quarter. Or you might have to have a higher payment in the fourth quarter than you anticipated. It's because that credit went away. And again, there's state extended benefits. So claimants, if after the PUC ran out, they just hit the state extended benefits, which carried them through early September. Okay. So as I mentioned, state unemployment climbed to 13.4%. The average loss of revenue for nonprofits, and I think y'all would agree, was 26 to 50%. This information, by the way, came from the Alliance. Thank you very much. The loss of income was 91 million. expenses increased in aggregate of 15 million. And just was talking to Jennifer about this, charitable donations have dropped 52%. So I would imagine from an operation standpoint that costs have gone up in terms of operating, changing, so, making things compliant for the workforce. Things cost more, and then just the kind of the challenges with the pandemic, obviously. All right. I haven't touched this in the past because it's kind of not really stimulating, but I think it's important because of the pandemic, and this is what we've heard from our members nationwide, because every state has this. I mentioned the standard base period, 26 weeks, and is what a person can claim. How is that calculated? Is that the state takes the first 4 of the last 5 completed quarters prior to the date of the claim. So let's use that March 15th magic date, a claimant filed. Well, they don't use first quarter of 2020's charges. They went back to 2019. So how that impacted employers, nonprofits or for-profits, is they saw claimants from folks that maybe weren't with them at that time, or have not been with them for a couple of years. And then obviously fraud claims were a huge deal across the board. So that standard base period got a little bit muddled due to the pandemic, because they added a minimum wage earners were able to qualify. So even if you didn't have a lot in wages that would normally be required, the state kind of put that rule aside for a period. So what that did was just increase claimants, claim activities for everybody. Then there's an alternate base period which the state can use, and that's where they use the 4 most recent claims before filing claims. It's the alternate base period. Again, it comes in times of basically economic downturn. So that is dependent on the state, but the standard base period, that calculation is always the same. Here's a visual of what it looks like in terms of last employer, base period employer. So that's what we heard, is a lot of people not only had base period employees claimants, so you had a reduction in staff, you expected those 20 people that had to be laid off to claim, but what really happened is people saw claimants again from working from them in the previous quarter, the last quarter of the previous year, and I've heard as far back as a year. So once a claim is filed, that claimant can collect for up to 2.5 years. So you might be hit with the last employer claim, even if it's 25 cents. So if nothing, it's just kind of tedious for the person that's managing the claims. All right. Where do we go from here? So as I mentioned, the provisions from the legislative programs that the feds put out have expired. All of them expired in September. So the 13 weeks of extended benefits expired September 11th in Arizona, and so did the subsidy in beginning of September. As I mentioned, there's governors who, determined to no longer participate in the program. Arizona was one of them. So when Governor Ducey in May, just like here in Texas, announced that they would be withdrawing, that made employers liable for 100% of benefits starting in May. And then effective this year, based on a Senate bill that was passed, or legislative bill that was passed rather, a claimant is going to be able to get an additional $80 a week. So while that's good from a claimant standpoint, effective 7/1/2022, basically what that means is they're going to have to collect more tax money or UI funds from employers to be able to pay those additional benefits of $80. So, $80 a week times 26, that's about $500 more. So the only way they're going to get that is from employers. That's another example of the socialized cost of the state tax pool. This is a huge deal, and I don't mean to have a smile on my face, but I honestly was shocked when this happened because, as far as I've heard, Arizona's been at the federal wage-based minimum of $7,000 forever. In my downtime with COVID, I read about Arizona DES's history, and I can tell you it was almost 25 years ago. So effective 1/1 of this year, the wage base is going to go up to $8,000. So it's going to be $1,000 more that employers are going to have to calculate based on that rate. That is a lot for most organizations. So whether you're small or you have a lot of employees, that additional $1,000, could be representative of anywhere from $10 to $50 per head, depending on what your rate is. So that is a big deal, and I did cite the state bills in case you want to reference it. There's still activity and talk going on a federal level about state unemployment. So after the CARES Act 1 and 2, we saw the HEROES Act, we saw the HEALS Act, and they didn't really change much in terms of what had happened from the CARES Act in terms of waiving the waiting period for claimants or removing the work search requirement. But what it did do, in my opinion, is bring the state unemployment system as a whole to the attention of the feds. And so much so that as part of the HEALS Act, I believe the feds are giving states a lot of money, excuse me, to improve their systems. So make things more streamlined because when they allowed gig workers to collect from the CARES Act, part of the problem or challenge rather was that obviously these people are not in the state system. So that's kind of why they used the method they did, where they just picked a fixed number of 600 or 300, is that there was really no way for them to determine what amount to pay an individual when they didn't have data for 50% of the people they intended to pay as in the 1099. So, and that's an important fact that's going forward. So there is, I'm sorry, where is it? Here we go. The CARES Act ended, as we know. What is going to be coming forward is, I don't know if you are aware, it's called the Wyden Bennett plan. It's part of the infrastructure bill that's been going around for quite some time now. And basically that's calling for a full revamp of the state unemployment system. That includes, again, the technology, which they've already started. But more importantly, what they want to do is tie the wage base average, meaning how they calculate a claimant's benefit award. They want to tie that to economic factors, state unemployment, wages. So the increase of $80 per head, or sorry, $80 additional in claimant, that could change with this plan, as well as keep allowing or providing unemployment benefits for gig workers. This plan speaks to that being permanent. and then they have a calculation of how they want states to determine that. And so if that infrastructure bill changes or passes, and there's not a lot of changes, this Wyden Bennett plan will really be impacting states nationwide on how they manage it, the solvency requirements of the state fund, ability to borrow money when needed, and more importantly, it's going to create some standards that will, again, likely increase in costs for employers. So, are there any questions that popped up?
I don't see any coming through, but I'm going to remind everyone that if they do have questions, they can put them in the chat and we will get them answered.
All right. Maybe they're just shy. All right. So First Nonprofit, if you don't know what we do, essentially we help nonprofits. I think Jennifer P. can attest to this. We'll talk to anybody that has any questions. I know there's a lot of startups, and sometimes there's a lot of questions if you need to or you don't need to, or when do you need to, or how does that look? So please feel free to reach out or ask questions now, or if you know of some specific topic you want to cover, just feel free to reach out to me. So what we do is we compare how you're currently funding state unemployment, whether it's self-insuring or with the state, and find out what's the best option. Is it to stay with the state? We typically provide a rate projection that's dependent on the state releasing the schedule. So if we have that, we will certainly include the rate projection. Historically, we do because the information is available. But I do want to be transparent that if we are not able to provide that, we'll let you know. It depends on the information when it becomes available. So the program also includes claims administration. So you have the benefit of having an expert that will help you through that process. It becomes electronic, and you have the support of that. So we typically save most organizations 27% versus the state tax. And our members stay with us in Arizona for 9 to 10 years, and we have about a 98% retention rate. There's no cost or obligation. And if you are, reimbursing, same thing, there's no cost or obligation. And we do provide Alliance members a 20% discount. So we recognize your partnership, and we certainly want to try to help out anywhere we can. So basically, what we do is try to evaluate your risk. Can you benefit from reimbursing? What would it look like? We do provide a fixed cost, and with our programs, unlike the state, in addition to the services, you also get the benefit of possibly getting some money back in the program, or be part of a interest-bearing program where you have a reserve account that pays the claims out and then gains interest, and then those all include the TPA service. I know that the Alliance has a partnership with COES Global. We do as well. We also have a group purchasing partnership with Commonwealth Purchasing, and the cost pricing in Arizona is one of the best in terms of competitiveness. So our members get the benefit of that, and they basically will do the pricing for you on what supplies you need. And then we also have formerly Think HR, it's now known as Mineral. So we've tried to, Jennifer can remember the time that we didn't have all these things. So we have, really tried to help provide resources to our members. And those services are at no additional cost other than the discount background services. So we've heard great things about the mineral, particularly in the last year. They're a great resource for HR support. And if you have your human resources certification, they provide free continuing education, which is great. So this is what we would need to provide you an estimate. Is basically an application and then some state reports. The Alliance has a link directly to our site and can get an application off there. And then I'd be happy to provide you with what information we need in addition to that. One important note for those folks that are tax rated, there is a annual notification deadline of December 1st, and then the effective date becomes January 1. And so if you miss that December 1st date, unfortunately, we have to wait another calendar year. So this is really the best time to get an assessment and see if we can help you save money. And again, if we can't help you, we definitely let you know that. And I can say from experience that we err on the side of caution. And sometimes, you know, if the savings isn't worth it, or we think your rate is, you know, decent, we have no problems letting you know that. So we just appreciate the opportunity to, you know, educate, inform, and just take a look and see if we can help. Because I think if there's a time to do it, in my tenure with this company, this is really it, because there's just not, you know, now we have, you know, the state has changed the wage base. That's really significant. And now we've got the feds kind of have a spotlight on the unemployment. So I think changes are coming. A lot of it will be managed through the state, but, you know, the pooled costs, I think, are going to be increasing in terms of wage benefit payments, and the Wyden Bennett plan will increase that. And frankly, if they comfortably increase the wage base $1,000, who's to say it can't go up again? Some states raise it every year, like Colorado. So that is really what I have. And I'm sorry, I thought Jennifer was going to be on here today. So, but here's my contact information, and feel free to email me or call me. And I'm happy to take any questions, because we've got 15 minutes left.
Yes,
unless
we
you
do.
guys are starving.
No, no, but if we're a small enough group that if you have questions and want to unmute, feel free to do that thing.
And I guess I'll give some, go ahead.
Beth, this is Jennifer Purcell. Just a question about when the state of Arizona typically makes decisions on increases or changes to the state unemployment.
That's a great question. So they can actually make changes anytime they want. So they could increase the rate and make it retroactive. They can, in Texas, there's an obligation assessment tax because Texas has had to borrow $7 billion since March. So they can do anything they want and tack it down any way they want. So that's a great question, because the answer is whenever they want. That's kind of why we monitor a lot of stuff. So we keep an eye on this, like, you know, when I started, and I think I've even mentioned it to you, Jennifer, when back when I started 8 years ago, there were rumblings on a federal level to change the wage base. And I never thought I'd see the day that the state increased it, because that is, you know, typically the states don't like to be the bad guy. And California's at the same wage base as 7,000. And honestly, I thought they'd do it before Arizona. But so they can, to answer your question, the state can make changes anytime they want.
Okay,
Yeah.
great.
Yep.
So Beth, we do have a question in the chat.
Great.
So someone wants to know, what are the risks of being self-insured as a nonprofit?
That's a great question. You mean solely on their own, not with a third party? I'm assuming that's the question. Difficulty
So if
budgeting.
Mary Ellen has additional like clarification, you feel free to unmute or you can type that in the chat box.
Okay, so I'm going to assume that it's someone who's self-insured on their own, not through a third party. So the challenges are budgeting, because I made that example of it's really not just the people you have underneath your roof that you have to consider. It's people that had worked for you previously. So it's budgeting. It is exposure of cost, because maybe you budgeted for 26 weeks, and then here we have the additional state extended benefits 13. That's so, and it's just a transfer of risk that you're not on the hook for, all those claims. So imagine during the CARES Act initial phase, before we got clarification, they were holding, and Jennifer, and I think everybody who was here last year remembers, they were holding nonprofits 100% responsible for claims. They were holding them, to the fire, frankly. And so that's kind of what you're looking at, is that kind of exposure, is you're covering 100% of it. So would having a fully insured coverage and a fixed cost, a fixed fee be beneficial, and transfer that risk? And what we're seeing, and what honestly the beauty of part of what we do for our folks on our quotes is we help you determine what your liability is. So the liability from COVID is not over. People are still seeing that. States are providing, are opening second claims for people. So budget, predictability, risk transfer, and I would have to say some of the services might be helpful, because if you're self-insuring, you're probably managing those claims on your own as well. So hopefully that answers Mary Ellen's question.
Great. It looks like she said yes. So I believe
Mary
that
Ellen.
is helpful. Yes. She says thank you.
Okay. You're welcome.
We do
So
have
if I may, go
yes,
ahead. I'm
of course.
sorry.
Oh no, you can go ahead. We do have another question though, so whenever you're ready.
No, go. Questions first.
Okay. Has there been any information given regarding if an employee is terminated for failure to comply with mandated vaccinations, if there will be any relief to employers?
That's like the $90 million question, right? No, there has not. Speculation is, and it depends on the state, of course, and the feds, but speculation is there's talk about, and I think there was just an article for one state, and I'm sorry, I can't remember the state, but there are states that are denying, there is one state that is talking about denying benefits for claimants due to the vaccine. So it's possible, yeah. There's some talk, I don't know at what level in Arizona, and I don't think it's a federal thing, but yeah, kind of.
Yeah, kind of.
I mean,
yeah.
Things are very, very fluid. As I think you all know, it's just because it's quieted down doesn't mean that things aren't happening. So I just think it depends. I think everybody on the phone would agree that that kind of stuff also is contingent on how things are reopening and the economy is coming back, or how bad claims are impacting a state. So I would imagine, it's just kind of like anything else. It depends on your state and kind of where that state lies in terms of policies. So I do think it's a possibility, but specifically to Arizona, I have not heard anything. If I do, I will let the Alliance know.
Perfect. Thank you.
You're welcome.
Yes, Patricia says she just wanted to make sure, because there's so much information out there, and I think that we're all struggling with trying to determine what is correct information.
Yeah, and even if you think it's correct, it changes like a day later. So, yeah, I understand, but I will, I know it was in Arizona, that was in the article that I looked at really quickly. But if I hear anything, I will certainly let you know. If I could take like 2 minutes just to touch on startups, just to see if there's anybody on there that this might help. The state doesn't require that you apply for state unemployment until you have 4 employees that work at least 20 consecutive weeks. Now, you can apply and ask for an exception to that, but that's usually the general guideline. And the other thing is, if you are a new nonprofit and just starting up, a lot of times the new employer rate, which ranges from 2 to 3%, typically is the way to go, because obviously that's pretty low considering the max is 20 and the minimum is 1.6. So, and that rate is for at least 2 years. So I do want to share that just in case we have any people that are with a startup or need to know that.
Perfect. Thank you.
You're
So
welcome.
don't see any other questions in the chat.
Okay.
So I will give my wrap up spiel, and then if there are any that pop up while I'm doing that, then we can get back to that. How does that sound?
Sounds great.
All right. So Beth, thank you so much for presenting today. It's always an important topic, especially because everything is changing so quickly. Karina is dropping the survey for this session in the chat so that we can give Beth feedback. That's important both to us and to our speakers and funders. So please complete that at your leisure. We have a ton of trainings coming up about, various things similar to unemployment insurance. So we have, trainings coming up about health, vision, and medical insurance, or in dental insurance. We have trainings coming up about the philanthropic sector and the kinds of trends that are occurring there. We have trainings on workplace safety. So we have a lot of options. Currently, we have over 50 trainings listed in our event calendar. So please check that out to make sure that you are getting all the information that you need to be successful. And then I don't see any other questions in the chat. So thank you so much for everyone for attending. Beth, again, thank you for joining. And then we will see everyone hopefully soon at a future training.
Thank you, everybody. Thank you, Jennifer, Angela, Karina.
Thanks, Beth.